Okay, so now we're working on number 35, problem 35 in chapter 5. We're on page 247, 248. This particular one starts out with, says these are the numbers for December 31st, 2015. It's a 60% interest that was acquired on January 1st, 2014. So one of the two questions, we have one prior year again, just one prior year. 2014 is a prior year, 2015 is the current year. And it says that they bought 60% in exchange for $570,000, and that the NCI was $380,000, and book value was $850,000. But before we do that, let's see what method they're using. So $570,000 was the price that was paid. I know it is not initial value because the investment in Keller on page 248 is $726. If it had been initial value, it would have been $570. So it's either partial equity or equity. So which one is it? Well, if it's partial equity, it's our 60% of Keller's net income. Keller's net income is $140,000 times 60% is the equity in earnings of Keller Company of 84, so it's partial equity. If it was less than that, then it would be the $84,000 minus amortizations. This is partial equity. So once again, the investment balance has changed, which tells me it's partial equity or equity. And the fact that Gibson's income account of $84,000 does equal 60% of $140,000 means they have not recorded the amortizations. Therefore, it's partial equity. I will need a star C. Okay. It also says they have an inventory and a land sale. The land was last year. The inventory is both years. So real similar to number 30, we're going to need a star G, a G, and a TI for the inventory category. We're also going to need a star TL for the transfer of land last year. The good thing is we don't have an ED because land doesn't depreciate. Okay. We will need a star C because it's partial equity. And then we'll need setup. We will need an I and a D if they have dividends. Did they? And they did declare dividends. Keller did declare dividends. So we do have a D, we do have an I. So far so good. All right, so the next step is, let's do the DDES. And it is on page 5-45, right here. We paid $570. The NCI is given to you as a value of $380, is a total of $950. The $850 is given. We determine our excess to be $100, and it says all of that is a customer list with a 20-year life. 100 divided by 20 is 5,000 per year. Okay. My star C is real easy then. It's one prior year, 1 year times 5,000 equals 5,000. And it will decrease the parent's retained earnings and decrease the investment. Because the investment did go up for net income, it just didn't go down for dividends. Okay. I don't think our star C has to have that TA, but let me double check. Star C. Yes, it does. Divide by 20. Oh, times. Yeah, we do. We have the, so I'll stay corrected. We'll come back to star C. But that 5,000 is part of your star C. So now let's do our G and our star G. And so they tell us on page 248, Keller sells to Gibson. This is again upstream. Okay, so that's going to affect our NCI. It's going to affect, will not affect star C, but the sale of land was, no, that one, okay, so I'm getting ahead of myself. So our star G, it says that Keller sold in 2014 $100,000 at a price of $150. So it's the 150 times 150 minus 100 over 150. This is 2014, and it says at the end of the year, in each of the years, 20% was not resold. So times 0.2. So my star G, which is the 2014 deferred gain, is $10,000. In 2000, that's star G. My G is the next year. They sold shipments total 200,000, cost 140, and again, so 200 times 200 minus 140 divided by 200. Again, 20% remaining, and that is, don't know, that is 12,000. So we have our star G at 10,000, our G at 12,000, and our TI is 200,000. All right. So we've got, we also need our TL. So the good thing is it's just, there's no accumulated depreciation on the land. So it says on page 248, Gibson sold Keller land with a book value of $60,000 on January 2nd for $100,000. So there was a $40,000 gain. And so that gain, in 2014, it would have been debit gain, 40,000, and credit to land of 40,000. That would have been the 2014 transfer of land. But 2015, our star TL, that gain is now retained earnings of the seller. Land, of course, is still land. So that's our star TL, retained earnings of Gibson. So we've got our star G, our TI, star TL. Let's go to our C. The explanation of your C is on some page, no, not there. Sorry. 545. Yes. Partial equity. So the parent share of amortization, so 5,000 times 60% is 3,000, must be recognized. And also, must be recognized the previous year. In addition, the equity accrual recorded by the parent had been based on their reported net income. As shown, 10,000 of that reported net income has not actually been realized. So, so our star C, I'll do it in a different format. Our star C is the gain deferred on the land of 10,000. 10? No.
From 2014 or?
Star G, sorry. It is the stars. Okay. Yeah, the 10,000 was the parent. That was downstream. Okay, so your star G was an amount of $10,000. Your G was an amount of $12,000. And your amortizations were $5,000. So that is a negative. The star G is going to be for gain. Yeah, you don't have to do your G because that'll be taken care of in the G entry. Okay. So it's just the star G and the G. Where am I getting 9,000 back? Add them together, Lynn. You are taking away gain. Gain Star G, 10,000 because it was upstream. I just did this a few minutes ago, now I can't even do it. It's $15,000 times 60% is $9,000. Both of them are negatives. So it's going to decrease retained earnings, decrease investment. The parent recorded or the subsidiary recorded a gain of $10,000 that we want to remove. So the retained earnings is overstated by $10,000. We also did not record the amortization, so this is to remove the 10, record the 5. Remove the 10, record the 5. But we only do our share, which is 60%, is $9,000. That's your Star C amount, and it's a debit to retained earnings and a credit to investment. All right, so we got our stars. Now I'm going to put up the worksheet. So, do our stars first. Doesn't really matter which star. So we just did the Star C, reducing the parent's retained earnings by 9,000 and reducing the investment by 9,000. If it had been downstream in equity, which it wasn't, then we would have used the Star G. It's still $9,000. Okay, so then we did the Star G. That would be the one that would be a different one, would be retained earnings. Have we done downstream in equity? 10,000 there, 10,000 the seller. Then our Star TL, 40,000 and 40,000. And we've got all of our stars. And we're ready to do setup. So setup, we go and we look, we have changed Keller's retained earnings by $10,000. So we've got only 610 to remove. 620 minus 10. So we remove the rest of it. We also remove the common stock and the APIC. This one does have APIC. So 320 plus 90 plus 610 equals 9,020,000, I think. I'm not sure. Whatever. The sum of those three times 60% goes here. Credit to the investment, and times 40% goes there, credit to NCI. Right. SA, so the A, the allocations from the DDES, only one allocation, that was a customer list, 100,000 originally, minus 1 year times 5,000 is 95,000. So you go back to page 5-45, where you've got the 100,000, 5,000 a year, 1 year, 100 minus 1 times 5,000 is 95,000. And then the other side of it, 60% here, 40% there. So the S and the A, split them. The I, we go find the parent's income and get rid of it. Debit there, credit here, no split. The D, we eliminate the parent share, 60% of 60 is 36, and the rest of that goes into the NCI column. So 60 debit with a 36,000 credit is a $24,000 debit in NCI column. We can go ahead and finish the dividends. The 115 goes across. 115 to 115, 60 minus 36 is 24. The E, there's only one thing on the E, and that's one expense of 5,000 against the customer list. Where we have an A, you've got an E except for land and goodwill and indefinite assets. And then there is a P. They tell you that somewhere. How do I know that? Oh, just above where they give you the numbers, it says Gibson owes Keller $40,000 at the end of 2015. It's just a sentence unless there's a separate account due from or due to Keller or Gibson. So in this case, it was a sentence, and it's reducing receivables, reducing payables. So credit your receivables, accounts receivable credit, and debit your payables, liabilities debit. Doesn't matter who owes whom, it's reducing. Okay? Then we make sure that both columns fit, 1,551,000. And we need to do our NCI income. That's given to you on page 5-47. Keller reported the 140. We have a $5,000 amortization each year. Because Keller upstream inventory, we want to add in the 10, which is the star G, and subtract out the 12, which is the G, and that gives us $133,000 of adjusted subsidiary income. 40% of that belongs to NCI. Credit here, debit there.
Can you say that one more time?
The $140,000 minus the $5,000 of expenses minus the 12 plus the 10 gives us $133,000. See, the TI is all in the income statement. It's just a debit and a credit. The $84,000 is the parent's adjustment. So it really is all of those in the income statement that have to do with the subsidiary. It's probably the first time I've said that, but is that a little bit more helpful instead of memorizing it? And then, so that $133,000 times 40% is this number. You just put it there and put it there. It's a credit, so it's added to the NCI column. It's subtracted from the consolidated column. And now we just go across, but remember, and I didn't do this on the last one, so I'm going to do it here. Credit, debit, debit is that big a credit, with a debit is that much credit. This is not the same as, it doesn't foot across. That 279,800 is down, and then it's put there. Gibson's retained earnings was adjusted for the 40 and the 9. Keller's was eliminated, and then net income came from above. It's only the parent's dividends. Put it down is that number, and put it there. And then the rest of them can be fitted across. There's always 0 here, there's always 0 there. And your consolidated assets equal your consolidated liabilities and stuff.